The fund's effectively positioned for a normalisation in US interest rates. So what does that mean? It means that we're 100% effectively in US dollars, we have large regional banking positions, and we also have significant stock exchange holdings. All of these businesses in a raising USA interest rate environment should increase profitability. We have two large stock exchanges, Chicago Mutual Exchange and also the Intercontinental Exchange. When you look at those businesses, as interest rates have been zero, the volumes have dramatically declined. And the reason they've dramatically declined is that when interest rates are at zero, nobody is hedging the risk because there isn't a lot of risk when interest rates are zero. But as we normalise interest rates going forward, that is, as they increase, the cost to hedge should dramatically increase, which means that volumes should increase. If we look at the current volumes in Chicago Mutual Exchange, they're about 30% below where they were in 2007. So we think that as we normalise, volumes will dramatically increase, which will increase the profitability of the firms. And from our point of view, we're not sure when volumes will rise, but until they do, we're getting a 5% dividend yield. We have significant positions in the European banks, and the main reason we have them is we think that bad loan provisions have peaked, the businesses have excess capital, and they're in a position where they will start paying dividend yields that should be 5 to 10% per annum. If we look at ING as a great example, ING successfully IPO'd their insurance business this quarter, and as a result, they have about 10% of their market cap in excess capital that management, if they wish to, can give back to shareholders. If we look at the current operational environment, if the management paid out 100% of the earnings, we would be getting a 10% dividend yield, and the business is trading at 1x book value. The European banks are probably 2-year lag behind the USA banks. So as the European economy gains traction, we believe that we should see significant re-rating in the stocks to 1.5 to 2.5x book value. We should see the dividend yield dramatically increase, or the dividend payout ratios dramatically increase, where we believe we'll be getting a 6 to 10% dividend yield per annum. And we also believe that the excess capital that has been accumulated over the last couple of years should also be paid out. So from our point of view, they are a great business as interest rates normalise in the US and across Europe. The Australian dollar declined 7.5% over the quarter. We're positioned 100% in US dollars. As normalisation in interest rates occurs, we believe that the Australian dollar will continue to break down. When you overlay the current environment in commodity supply and demand, whereby commodities are significantly oversupplied, we believe that the Australian dollar over a longer term perspective should continue to weaken. As a result, we are effectively 100% US dollars.